In the early 2000s, the American dream of homeownership was the engine of the global economy. Banks were lending money to people who, under normal circumstances, couldn't afford a mortgage. These were called subprime loans, named because the borrowers had lower credit scores and higher risk of default. But banks didn't keep these risky loans on their own books. Instead, they bundled thousands of these mortgages together into something called a mortgage-backed security. Think of it like a giant basket of debt, sold to investors around the world who were hungry for steady returns. To make these risky baskets look safer, they were sliced into layers called tranches. Rating agencies, whose job was to assess risk, often gave these complex products top-tier ratings. Investors assumed that because they were rated AAA, they were as safe as government bonds. Wall Street then took this a step further with credit default swaps. These were essentially insurance policies against these mortgage-backed securities failing. It was a massive, unregulated betting market where firms like AIG were selling insurance on products they didn't fully understand. By 2006, the housing bubble in the US reached its peak. Home prices were rising so fast that people believed they would never fall. Borrowers kept taking out loans, and banks kept creating more derivatives to meet the global demand for these high-yield assets. But in 2007, the clock started ticking. Interest rates rose, and subprime borrowers started missing their mortgage payments. As those payments dried up, the value of those mortgage-backed security baskets began to plummet across global markets. Suddenly, the world's biggest banks realized they were holding trillions of dollars worth of assets that were essentially worthless. No one knew who owned which bad debt, leading to a total freeze in trust between financial institutions. On 15 September 2008, the hammer fell. Lehman Brothers, a massive investment bank with a 158-year history, filed for bankruptcy. It was the largest bankruptcy in US history, sending shockwaves through every stock exchange on the planet. As Lehman fell, panic turned into a global contagion. Banks stopped lending to each other entirely because they feared their counterparties were about to collapse. The credit markets, the lifeblood of the global economy, simply stopped working. Governments were forced to step in. In the US, Congress passed the TARP program, injecting billions of taxpayer dollars into banks to prevent a total systemic meltdown. It was a controversial move that saved the system but ignited massive public anger. The aftermath was severe. Millions of people lost their homes, unemployment rates surged, and the global economy entered the Great Recession. It took years for wealth, jobs, and confidence to slowly return to the markets. The ultimate lesson of 2008 is about the danger of complexity. When financial products become so complicated that even the people creating them cannot explain the risks, they stop being investments and start being hazards. History shows us that when the foundation of trust erodes, the entire structure eventually falls.